Look, I need you to sit down for this one, because yesterday we were talking about silver hitting $100, and I had half the comment section calling me delusional, telling me I'm fear-mongering, telling me I'm just trying to pump my bags. Well, guess what just dropped? A major European investment firm, All Ag Funds, managing billions of dollars, just published their official 2026 outlook, and they're not talking about $100. They're talking about silver exploding to $133 per ounce this year. Not next decade, not in some fantasy scenario this year. And gold, they're forecasting $6,000. Now, before you think this is just another clickbait headline or some conspiracy theorist in his basement, understand that this is a regulated institutional fund that manages real money for real clients, pension funds, sovereign wealth allocations, the kind of money that moves markets. The suits want me to tell you this isn't financial advice. Of course it isn't. It's a survival guide for a burning theater. Do your own research, if you still trust the people who stole your purchasing power. But what I'm about to break down for you is the exact same intelligence that the smart money has been acting on for months, while Bloomberg and CNBC have been distracting you with Taylor Swift and political theater. The crime scene we're looking at today isn't on some random chart. It's in the institutional playbook that just got leaked to the public, and if you understand what I'm about to explain, you'll realize that everything we've been warning about on this channel, all the vault drains, all the COMEX inventory collapses, all the Chinese accumulation, it's all been validated by a multi-billion-dollar fund that has every incentive to be conservative with their forecasts because their clients will sue them if they're wrong. Let me know in the comments below, and I really want to hear from you on this, because the data I'm seeing suggests that retail got absolutely destroyed in the last 2 weeks. Did you get shaken out by the orchestrated paper crash this week, or are you holding with diamond hands for triple digits? Because what this fund manager just confirmed is exactly what we've been screaming about on this channel. Those crashes you saw, that 20% drop, that liquidated leveraged positions, and had the Reddit silver community in full panic mode, that wasn't organic. That wasn't natural market movement. The report explicitly states, and I'm going to read sections of this thing verbatim so you understand I'm not making this up, that these pullbacks are orchestrated, designed by institutions to shake out weak retail hands so the quote, strong hands can buy cheaper. They're telling you in plain English that you got robbed. They engineered volatility to steal your silver, and you sold it to them at a discount because you got scared. This is the same playbook they ran in 2008 when gold dropped from 1,000 to 700 and retail panic sold into institutional buy orders. It's the same playbook from March 2020 when silver crashed from $18 to $12 and JP Morgan scooped up 900 million ounces of physical at basement prices. It's the same playbook from November 2024 when Trump won the election and they slammed gold and silver to shake out the weak hands before the next leg up that took gold from 2,600 to 2,800 in 6 weeks. Are you starting to see the pattern here? Every single time retail gets confident, every single time the comment section starts talking about silver going to the moon, they engineer a coordinated paper dump to psychologically break you, to make you question the thesis, to make you sell at a loss, so institutions can accumulate at your expense. Now, let's talk about the mechanism behind this $133 target, because this isn't hopium, this isn't some gold bug fantasy, this is mathematics and institutional game theory. The fund manager's report centers on one undeniable reality that central banks and governments can no longer hide. Global debt is approaching $350 trillion. Not billion, trillion with a T. $350 trillion of debt obligations that governments, corporations, and financial institutions owe and have absolutely no ability to pay back in real terms. Let me put that number in perspective for you, because most people hear trillion and their brain just shuts off. It doesn't compute anymore. If you took the entire GDP of the United States, the largest economy in human history, about $28 trillion, you would need 12.5 years of every single dollar of economic output with zero spending on anything. No military, no social security, no government salaries, no infrastructure, just pure debt pay down, and you still wouldn't cover the global debt. It's mathematically impossible to service this debt with organic economic growth. The global economy is not growing at a rate that can generate the tax revenue and corporate profits needed to make interest payments on $350 trillion. So what happens when the debt bomb is too big to defuse? You monetize it, you print currency, you devalue the measuring stick. And that's exactly what the Federal Reserve and every major central bank on planet Earth is preparing to do right now in 2026. The AUAG report makes this explicit. They're saying that central banks have no choice but to cut interest rates and restart quantitative easing on a scale that will make 2020 look like a dress rehearsal. Think about what happened in 2020. The Fed printed $4.5 trillion in a matter of months. They expanded the money supply by 40% in 1 year. And what happened to gold and silver? Gold went from $1,700 to $2,100, a 24% gain. Silver went from $12 to $30, a 150% gain in 4 months. That was with $4.5 trillion in money printing. Now fast forward to 2026, the debt has grown by another $15 trillion since 2020. The structural deficits are larger. The interest payments on the debt have tripled because rates went from 0 to 5%. The US government is now spending $1.1 trillion per year just on interest, more than the entire defense budget, more than Medicare, just interest on the debt. And every single economic indicator is flashing warning signs that we're heading into a recession, which means tax revenues are about to collapse while entitlement spending explodes. So you take collapsing revenues, exploding mandatory spending, and $1 trillion in annual interest payments, and you tell me how that math works without the printing press. It doesn't. The only way out is to print currency, suppress interest rates below the rate of inflation so the debt inflates away in real terms, and sacrifice the purchasing power of every person holding dollars. When fiat currency is printed to infinity, and that's the phrase the fund uses, printed to infinity, real economic GDP drops because you're diluting the value of every existing unit of currency. If there are $100 in the system and you print another $100, you didn't create wealth, you just cut the value of every existing dollar in half. And when the value of the currency drops, hard assets like gold and silver explode to account for the currency debasement. This isn't speculation, this is accounting. Silver didn't go from 35 cents in 1971 to $50 in 1980 because silver became more valuable. It went up because the dollar became worthless after Nixon closed the gold window. Silver didn't go from $4 in 2001 to $49 in 2011 because of some supply shortage. It went up because the Fed printed trillions after the dot-com crash and the housing crisis. And silver isn't going to $133 because of some magical industrial demand story. It's going to $133 because the dollar is being systematically destroyed to pay for government spending that has no limit and no accountability. The fund manager is telling you in this report that when central banks monetize $350 trillion in debt, the currency debasement will be so extreme that precious metals will have to reprice higher just to maintain their relative purchasing power against a collapsing fiat system. Now I read through these massive 50-page institutional fund reports so you can front-run Wall Street. I spent hours going through the data tables, the footnotes, the modeling assumptions, translating the institutional jargon into plain English so you understand what the smart money is actually doing while the financial media runs cover. If this level of deep dive macro research is helping you build generational wealth, if you're using this intelligence to make better decisions with your capital, consider hitting that super thanks button below to support the channel. I don't run sponsor ads for gold dealers that pay me to pump their premiums. I don't sell courses or memberships to access basic information. This channel runs on audience support, and the super thanks feature is how you can directly fund this research, so I can keep bringing you the institutional playbook before it hits mainstream media. Let's get into the second part of this report that absolutely confirms everything we've been warning about, the orchestrated drops. Listen to this language from the fund carefully. They state that the recent crashes, and they're specifically referring to the 20% drops we saw in silver over the past few months, are orchestrated pullbacks designed to shake out weak retail hands. They use the term strong hands, which in institutional language means the big money, the vaults, the sovereign buyers, the entities that buy by the ton, not by the ounce. This is them admitting in writing that price suppression is a feature, not a bug. It's part of the accumulation strategy. They dump paper contracts on the COMEX during low liquidity hours, usually Sunday night or early Asian session, to trigger stop losses and force liquidations from over-leveraged traders. Then they scoop up physical silver at the artificially suppressed price before letting the market recover. We saw this exact pattern on February 3rd when silver dropped from $33 to $26 in 72 hours on the COMEX, while physical premiums at dealers stayed at $5 to $7 over a spot. Think about that disconnect. The paper price crashes 20%, but the physical price, the real price, the price you actually pay to own metal, barely moved. That's the smoking gun. That's the proof that the paper market and the physical market have completely decoupled, and the price you see on the screen is not the price of silver. It's the price of a synthetic derivative that has zero connection to physical reality. The report goes further and highlights that silver's industrial demand is highly inelastic. Do you know what inelastic demand means in economic terms? It means that no matter how high the price goes, industries have to buy it anyway because there is no substitute. Solar panels need silver. Electric vehicles need silver. 5G infrastructure needs silver. Military applications need silver. You can't just decide to use less silver because the price doubled. The technology requires a specific amount of silver per unit, and if you don't have it, you can't manufacture the product. This is completely different from something like oil, where if the price spikes, people drive less, airlines cancel routes, consumers adjust their behavior. Silver demand does not adjust. It's baked into the supply chain. And when you combine inelastic industrial demand with investment demand from people trying to escape currency debasement, you create a supply shortage that the report says will, quote, easily double the price overnight. Not over years, overnight. Because once the industrial buyers realize there isn't enough physical silver to meet their manufacturing needs, they will bid any price necessary to secure supply. We've already seen previews of this in the solar industry, where manufacturers are paying premiums of 15 to 20% above spot price for guaranteed delivery, because spot market silver doesn't actually exist in the quantities they need. If you go to the COMEX and try to take delivery of a commercial-sized order, you'll wait months and pay massive premiums because the vaults are empty and the paper contracts are backed by nothing. I want you to think about what this means in practical terms. If industrial users are already paying premiums above paper spot price in 2026, what happens when investment demand kicks in? What happens when pension funds and sovereign wealth funds that manage trillions of dollars start allocating even 1% of their portfolios to physical silver? The entire above-ground supply of investment-grade silver bullion is estimated at around 2 billion ounces. Sounds like a lot until you realize that's only worth about $60 billion at current prices. The Norwegian Sovereign Wealth Fund alone manages $1.7 trillion. If they put 1% into silver, that's $17 billion chasing $60 billion of total supply. BlackRock manages $10 trillion. If they allocate half of 1% to silver, that's $50 billion, almost the entire investable supply of the metal. This is why the fund manager is saying the price will double overnight. It's not hyperbole, it's supply and demand math. There is not enough physical silver available at current prices to satisfy even a fraction of institutional demand if they decide to rotate into hard assets. And here's the part that should terrify you and excite you at the same time. The report confirms that the smart money already knows this. They're not waiting for the price to go to 133 to start buying. They're buying now while retail is panic selling into their bid. Every single vault drain we've documented on this channel, every withdrawal from the COMEX, every record purchase by the Chinese, every Perth Mint delivery delay, it's all part of the same accumulation phase. The institutions are loading up on physical metal while keeping the paper price suppressed through derivative manipulation so they can buy as much as possible before the squeeze happens. It's the greatest wealth transfer in modern history playing out in real time, and the only question is whether you're on the right side of it. I am tracking these institutional accumulation phases and vault drains every single day. I go through the COMEX inventory reports, the ETF flows, the import-export data from China and India, the US Mint sales figures, all of it, so I can identify exactly when the next massive leg up is about to begin. Make sure you are subscribed to the channel with the bell notification turned on so you know the moment the setup is in place, because when this thing breaks, it's going to move so fast that if you're not already positioned, you will miss the entire move. We saw this in 2020 when silver went from $12 to $30 in 4 months, and by the time the mainstream media started covering it, the move was already over. We saw it in 2011 when silver ran from $18 to $49 in 6 months, and retail only started buying after it hit $40, right before the top. The people who made generational wealth were the ones who bought in the 20s when everyone thought they were crazy. The people who made life-changing returns were the ones who understood the macro setup and positioned before the crowd. Right now in 2026, you are in that accumulation zone. The fund manager is telling you the target is $133, the vaults are being drained, the industrial shortage is building, and the paper price is being suppressed to shake you out. So the question is, are you going to sell into their bid, or are you going to hold with diamond hands and let them pay you triple digits for your metal? Now let's get into the mining stock component of this report, because this is where the asymmetric upside really gets insane. The fund explicitly states that silver mining stocks are historically undervalued and ready for explosive upside. And when I say historically undervalued, I mean compared to every previous bull market in precious metals. Mining stocks are trading at valuation levels that don't make any mathematical sense unless you believe silver is going to stay at $30 forever, which the fund clearly does not believe. Let me give you the math on this. The average silver mining company is producing silver at an all-in sustaining cost of about $22 to $25 per ounce. That includes extraction, refining, transportation, overhead, everything. At a silver price of $33, which is where we were before the recent dump, these companies are making maybe $8 to $10 per ounce in profit. Now take silver to $133 like the fund is forecasting. The cost to produce doesn't change, it's still $22 to $25 per ounce. But now the profit margin goes from $8 to over $100 per ounce. That's a 10x increase in profitability. And historically, when mining profitability increases by 10x, stock prices don't go up 10x, they go up 20x, 30x, sometimes 50x, because investors start pricing in forward earnings and the possibility that those margins sustain for multiple years. We saw this exact pattern in the 2000 to 2011 bull market. Silver went from $4 to $49, about a 12x move. But First Majestic Silver, one of the premier primary silver miners, went from 50 cents to $40, an 80x move. Pan American Silver went from $2 to $48, a 24x move. These stocks didn't just match the metal, they obliterated it because of the leverage inherent in the mining business model. When the commodity price goes up, miners don't just make more revenue, they make exponentially more profit because their cost structure is fixed. It's the same reason oil stocks explode when crude goes from 50 to 100. The incremental revenue all drops to the bottom line as pure profit. Now apply that to silver in 2026. If the fund is right and silver hits $133, the mining stocks are going to go absolutely parabolic. We're talking about potential 10 baggers, 20 baggers, maybe even 50 baggers on the best positioned companies with low production costs and growth profiles. But here's the catch. You have to be positioned before the move happens, because once silver breaks out and the mainstream starts covering it, the mining stocks will gap up so fast you won't be able to get in at reasonable prices. The institutional money is buying physical bars and undervalued miners right now while the public is distracted. They're building positions in the companies with the best jurisdiction, the lowest cost, the highest grade deposits, the management teams that know how to execute in a bull market. And they're doing it quietly, buying on weakness, accumulating during the orchestrated dumps when retail is selling in panic. This is how generational wealth is built. You don't wait for confirmation, you don't wait for CNBC to tell you it's safe, you study the macro setup, you identify the asymmetric opportunities, and you position before the crowd. If you want to see the exact silver mining stocks and physical assets I am buying to play this $133 target, click the join button and become an insider member today. Inside the members area, I break down the specific tickers, the valuation metrics, the technical setups, the risk management strategies, everything you need to build a precious metals portfolio that can actually capitalize on this forecasted move. I also post real-time updates when we see major developments, vault drains, COMEX inventory changes, regulatory announcements, anything that impacts the thesis so you're never caught off guard. But let me be very clear about something, because I know there are people watching this who are skeptical, who think this sounds too good to be true, who have been burned before by gold and silver predictions that didn't pan out. I'm not telling you that silver is guaranteed to hit $133 by December 31st, 2026. What I'm telling you is that a major institutional fund with billions of dollars under management and a fiduciary responsibility to their clients has published a report saying that based on the macro fundamentals, the debt trajectory, the money printing that's coming, and the supply-demand dynamics, $133 is the mathematical target. They're not guessing, they're modeling this based on historical precedent, current data, and forward projections, and more importantly, they're positioning their fund accordingly. They're buying gold, they're buying silver, they're buying mining stocks because they believe in the thesis enough to risk their clients' capital on it. So when I tell you that this is the setup, I'm not giving you my opinion, I'm giving you the institutional playbook and letting you decide what to do with that information. Now, let's talk about the elephant in the room that the fund doesn't explicitly address, but that we need to understand if we're going to make it through the volatility ahead. The 2026 repo market and the algorithmic trading systems that control price discovery in every major financial market, including precious metals. Because here's what most people don't understand. When you see silver drop 20% in 3 days, that's not 10,000 individual investors all deciding to sell at the same time. That's algorithms executing pre-programmed trading strategies designed to hunt stop losses, trigger liquidations, and create the illusion of massive selling pressure to scare humans into panic selling their physical positions. The repo market, which most people have never heard of, is the overnight lending market, where banks and financial institutions borrow money using treasuries and other collateral. It's a $20 trillion market that operates in the shadows and determines the actual cost of money in the financial system. When repo rates spike, it means there's a liquidity crisis, banks don't trust each other, and they're hoarding cash instead of lending. When repo rates are suppressed, it means the Fed is injecting massive liquidity to keep the system from seizing up. In September 2019, the repo market exploded. Overnight rates that are supposed to be around 2% spiked to 10% in a matter of hours because banks refused to lend to each other, and the system was on the verge of a complete freeze. The Fed had to inject hundreds of billions of dollars in emergency repo operations to prevent a collapse. Nobody in the mainstream media covered this. CNBC ran stories about the trade war and impeachment hearings while the actual financial system was on fire. Fast forward to March 2020. The repo market seized up again, rates spiked, and the Fed had to inject trillions to keep banks solvent. Now we're in 2026 and the repo market is flashing red again. Rates are elevated, liquidity is tight, and the algorithms that trade based on repo conditions are positioning for another crisis. These algos are programmed to sell risk assets including gold and silver when repo stress appears because historically that's been the pattern. Liquidity crisis equals sell everything, even safe havens, to raise cash. But here's what's different this time. In 2019 and 2020, the Fed could cut rates and print money because inflation was low. In 2026, inflation is structurally embedded in the system. Even if they get it down to 3 or 4%, which they haven't, the Fed can't go back to zero rates without triggering a currency crisis and hyperinflation. So when the next repo spike happens, and the fund manager's report suggests it's coming, the Fed will be forced to choose between saving the banks with more money printing or defending the dollar. And every historical precedent says they will choose the banks, they will choose to print, and when they do, gold and silver will go vertical because the market will finally understand that the dollar has no floor. This is why the $133 target isn't some moonshot fantasy. It's the market pricing in the reality that the Fed has lost control, that the debt can't be serviced without printing, and that hard assets are the only escape from a system that's designed to steal your purchasing power. The crime scene we're investigating isn't just the chart, it's the entire monetary system, and the evidence is overwhelming. You've got $350 trillion in unpayable debt, central banks with no choice but to monetize industrial demand for silver that can't be met with current supply, and institutional buyers accumulating physical metal while the paper price is being manipulated lower to facilitate that accumulation. Every single piece of this puzzle points to the same conclusion. Silver is going significantly higher, the only question is whether you're positioned when it happens. And I want to address something that I see in the comments every single time we talk about these targets. People say, if silver is going to $133, why isn't everyone buying it? If it's such a sure thing, why isn't every hedge fund and billionaire loading up? And the answer is they are. They're just not telling you about it. When JP Morgan accumulated 900 million ounces of physical silver between 2011 and 2020, they didn't send out a press release. They did it quietly, through their vault, off exchange, so nobody knew what was happening until the COMEX data showed up years later. When China started hoarding silver in 2024 and 2025, they didn't announce it. They just kept importing millions of ounces every month and building strategic reserves. The smart money doesn't broadcast their moves. They accumulate in silence and let the public figure it out after the price has already moved. That's why when a fund like AOAG publishes a report with a $133 target, it's significant. Because they're essentially telling you what the institutions have already known and acted on for months or even years. So let me bring this back to you and your situation in 2026. You're watching this video, which means you're already more informed than 99% of the population who have no idea what's happening in the financial system. You understand that the debt is unsustainable, that money printing is inevitable, that hard assets are the only protection against currency debasement. The question is, what are you going to do with that information? Are you going to wait for silver to hit $100 before you start buying because you want confirmation and you want to feel safe? Or are you going to understand that the setup is happening right now, that the institutions are accumulating right now, and that by the time the mainstream media confirms the move, it will be too late to position at favorable prices? The people who made life-changing wealth in precious metals didn't buy at the top when everyone was talking about it. They bought in the middle of the fear when everyone thought they were crazy. They bought when silver was being smashed by paper dumps and everyone said it was a dead trade. They bought when the institutional reports were saying exactly what this AOAG fund is saying now, but nobody was listening because they were distracted by short-term volatility. The report makes one more point that I think is critical for everyone to understand. They talk about the strong hands versus the weak hands. The weak hands are the people who buy silver because a YouTuber told them to, hold it for 3 weeks, watch it drop 10%, panic, sell at a loss, and then complain that precious metals don't work. The strong hands are the people who understand the macro thesis, who know why they own silver, who treat it as insurance against systemic collapse, and who add to their position when price drops because they understand that physical metal at a discount is the opportunity of a lifetime. The institutions want you to be weak hands. They engineer volatility specifically to psychologically break you, to make you doubt your decision, to make you sell at a loss so they can buy from you. Every single orchestrated dump is a transfer of wealth from impatient retail to patient institutions. The question is, which side are you on? If you made it this far in the video, you're clearly serious about understanding what's happening and positioning accordingly. This is not a get-rich-quick scheme. This is a macro trade that could take months or even a year or two to fully play out. But when it does, when silver breaks out and starts moving toward that $133 target, the gains will be generational. Not 10%, not 50%, we're talking about potential 300 to 500% returns on the metal and potentially 10 to 50x returns on the mining stocks if you pick the right companies. That's the kind of move that changes your financial situation permanently, that lets you pay off debt, buy real estate, build generational wealth for your family. But you have to be positioned before it happens. You have to be willing to hold through the volatility, to add on weakness, to ignore the fear-mongering from the mainstream media, and to trust the macro setup even when it feels uncomfortable. That's what separates the people who make it from the people who stay stuck in the system getting robbed by inflation and currency debasement. The institutional money is moving, the vault drains are accelerating, the reports are being published, the targets are being stated publicly. $133 per ounce is not a conspiracy theory. It's a mathematical forecast from a fund that manages billions of dollars and has every incentive to be accurate. The crime scene is clear, the evidence is overwhelming, and the verdict is in. Silver is programmed for a massive repricing in 2026, and the only question is whether you're going to be on the right side of the trade when it happens. Smash that like button to break through the algorithm suppression, drop a comment letting me know if you're holding through the volatility or if you got shaken out, subscribe to the channel if you're not already, and if you want the specific stocks and strategies I'm using to play this setup, click the join button and become an insider member. We are living through the greatest wealth transfer in history, and the decisions you make in the next few months will determine which side of that transfer you end up on.